Welcome. Today, we're diving into the world of tax-free investment accounts. If you're looking to grow your wealth efficiently, understanding these accounts is crucial. Tax-free investment accounts allow your money to grow without the burden of taxes eating into your returns. Whether you're saving for retirement, education, or a big purchase, these accounts can help you reach your goals faster. In this video, we'll explore the most popular tax-free investment options, how they work, and who can benefit from them. Let's get started by understanding why tax-free growth is such a powerful tool for investors. Before we jump into specific accounts, let's clarify what tax-free really means. In the context of investing, tax-free refers to accounts where your investment growth, interest, or withdrawals are not subject to income tax. This can make a huge difference over time, as taxes can significantly reduce your overall returns. Tax-free accounts are designed to encourage saving and investing for important life goals, and they come with specific rules and benefits. Understanding these rules is key to making the most of your investments. Choosing tax-free investment accounts can be a game changer for your financial future. By allowing your investments to grow without the drag of taxes, you can accumulate more wealth over time. This is especially important for long-term goals, like retirement or education funding. Tax-free accounts also often come with additional benefits, such as government incentives or matching contributions. In the next scenes, we'll break down the most popular types of tax-free accounts and how you can use them to your advantage. One of the most well-known tax-free investment accounts in the United States is the Roth IRA. With a Roth IRA, you contribute after-tax dollars, and your investments grow tax-free. When you withdraw funds in retirement, you pay no taxes on your earnings or contributions, provided you follow the rules. This makes the Roth IRA a powerful tool for long-term savers who expect to be in a higher tax bracket in retirement. Let's look at how the Roth IRA works and who can benefit most from it. Not everyone can contribute to a Roth IRA. There are income limits that determine eligibility. For 2024, single filers with a modified adjusted gross income, MAGI, below $153,000 and married couples filing jointly with a MAGI below $228,000 can contribute the full amount. If your income exceeds these limits, your ability to contribute phases out. It's important to check the latest IRS guidelines each year to see if you qualify. Even if you can't contribute directly, there are strategies like the backdoor Roth IRA that may allow you to take advantage of this account. Each year, the IRS sets contribution limits for Roth IRAs. For 2024, the maximum you can contribute is $6,500 or $7,500 if you're age 50 or older. These limits apply across all your IRAs combined. It's important to stay within these limits to avoid penalties. Regular contributions, even if small, can add up over time thanks to the power of compounding. Remember, the earlier you start, the more time your investments have to grow tax-free. Withdrawals from a Roth IRA are tax-free if you meet certain conditions. You must be at least 59.5 years old and have held the account for at least 5 years. Contributions can be withdrawn at any time without taxes or penalties, but earnings are subject to these rules. If you withdraw earnings early, you may face taxes and a 10% penalty. Understanding these rules helps you avoid costly mistakes and maximize your tax-free benefits. Another powerful tax-free investment account is the Health Savings Account, or HSA. HSAs are designed to help you save for medical expenses, but they offer unique tax advantages. Contributions are tax-deductible, investments grow tax-free, and withdrawals for qualified medical expenses are also tax-free. This triple tax benefit makes HSAs one of the most efficient savings vehicles available, especially if you have a high-deductible health plan. For 2024, HSA contribution limits are $4,150 for individuals and $8,300 for families. If you're 55 or older, you can contribute an extra $1,000 as a catch-up contribution. These limits are set by the IRS and may change each year. It's important to stay within these limits to avoid penalties. HSAs are a great way to save for both current and future healthcare costs, all while enjoying tax-free growth. Withdrawals from an HSA are tax-free when used for qualified medical expenses. If you use the funds for non-medical expenses before age 65, you'll pay income tax and a 20% penalty. After age 65, you can withdraw funds for any purpose without penalty, but non-medical withdrawals will be taxed as ordinary income. This flexibility makes HSAs a valuable tool for both healthcare and retirement planning. Many people don't realize that HSAs can be invested, not just kept in cash. Depending on your HSA provider, you may have access to mutual funds, stocks, and other investment options. Investing your HSA funds can help your savings grow faster, especially if you don't need to use the money right away. Be sure to review your provider's investment choices and fees to make the most of your HSA. If you're saving for education, 529 college savings plans are a top tax-free option. These state-sponsored accounts allow your investments to grow tax-free, and withdrawals are tax-free when used for qualified education expenses. 529 plans can be used for college, K-12 tuition, and even certain apprenticeship programs. Each state offers its own plan, so it's important to compare features and fees before choosing one. 529 plans have high contribution limits, often exceeding $300,000 per beneficiary, depending on the state. While contributions are not federally tax-deductible, many states offer tax deductions or credits for residents. Anyone can contribute to a 529 plan, making it a great tool for families and friends to help with education costs. Remember, contributions are considered gifts for tax purposes, so be aware of annual gift tax limits. Withdrawals from a 529 plan are tax-free when used for qualified education expenses, such as tuition, fees, books, and room and board. If you use the funds for non-qualified expenses, you'll pay income tax and a 10% penalty on the earnings. It's important to keep good records and use the funds appropriately to avoid penalties. Some plans also allow you to change the beneficiary if the original student doesn't need the funds. Another education-focused tax-free account is the Coverdell Education Savings Account, ESA. Like a 529 plan, a Coverdell ESA allows your investments to grow tax-free, and withdrawals are tax-free for qualified education expenses. However, Coverdell ESAs have lower contribution limits and income restrictions. They're a good option for families who want more control over investment choices and plan to use the funds for K-12 or college expenses. Coverdell ESAs have an annual contribution limit of $2,000 per beneficiary. Contributions must be made before the beneficiary turns 18, and there are income limits for contributors. While the limit is lower than 529 plans, Coverdell ESAs offer more investment options, including stocks, bonds, and mutual funds. This flexibility can be appealing for families who want to tailor their investment strategy. Withdrawals from a Coverdell ESA are tax-free when used for qualified education expenses, including K-12 and college costs. If the funds are not used by age 30, they must be distributed to another eligible family member, or the earnings will be subject to taxes and penalties. It's important to plan ahead to make the most of this account's benefits. Municipal bonds, or munis, are another way to earn tax-free income. Issued by state and local governments, the interest from most municipal bonds is exempt from federal income tax and sometimes state and local taxes as well. These bonds are popular with investors seeking steady, tax-free income, especially those in higher tax brackets. However, it's important to understand the risks and returns before investing. There are two main types of municipal bonds: general obligation bonds and revenue bonds. General obligation bonds are backed by the full faith and credit of the issuing government, while revenue bonds are supported by specific projects or sources of revenue. Each type has its own risk profile and potential returns. It's important to research the issuer and understand the terms before investing in municipal bonds. The main appeal of municipal bonds is their tax benefits. Interest income from most municipal bonds is exempt from federal income tax, and if you buy bonds issued by your home state, you may also avoid state and local taxes. This can significantly boost your after-tax returns, especially if you're in a high tax bracket. However, some municipal bonds, known as private activity bonds, may be subject to the alternative minimum tax, AMT. While municipal bonds offer tax-free income, they are not risk-free. The main risks include credit risk, interest rate risk, and liquidity risk. Credit risk refers to the possibility that the issuer may default on payments. Interest rate risk means the value of your bonds may fall if interest rates rise. Liquidity risk is the chance you may not be able to sell your bonds easily. Always consider these factors before investing. U.S. Series I and E savings bonds are government-backed bonds that can offer tax-free benefits when used for qualified education expenses. The interest earned is generally subject to federal tax, but if you meet certain income and usage requirements, you may be able to exclude the interest from your taxable income. These bonds are safe, low-risk options for conservative investors. To qualify for the savings bond interest exclusion, you must use the proceeds for qualified higher education expenses, meet certain income limits, and the bonds must be in the parent's name. The exclusion is phased out at higher income levels, so check the latest IRS guidelines. This strategy can be a useful supplement to other education savings accounts. Flexible spending accounts, or FSAs, are employer-sponsored accounts that let you set aside pre-tax dollars for healthcare or dependent care expenses. While not technically investment accounts, FSAs offer tax-free withdrawals for qualified expenses. However, funds must generally be used within the plan year, or you risk losing them. FSAs can help reduce your taxable income and cover out-of-pocket costs. FSAs and HSAs both offer tax advantages for healthcare expenses, but there are key differences. FSAs are generally use it or lose it, meaning unused funds may be forfeited at year-end. HSAs, on the other hand, allow funds to roll over indefinitely and can be invested for long-term growth. Additionally, only those with high-deductible health plans can open an HSA. Understanding these differences can help you choose the right account for your needs. It's important to distinguish between tax-free and tax-deferred accounts. Tax-free accounts, like Roth IRAs and HSAs, allow you to withdraw funds without paying taxes on the growth. Tax-deferred accounts, such as traditional IRAs and 401(k)s, let your investments grow tax-free until you withdraw them, at which point you pay taxes. Both have their place in a well-rounded financial plan, but tax-free accounts offer unique long-term benefits. Tax-free investment accounts are beneficial for a wide range of people. Young investors can benefit from decades of tax-free growth, while those nearing retirement can use these accounts to manage their tax liability. Families saving for education or healthcare can also take advantage of these options. The key is to match the right account to your specific goals and financial situation. To maximize the benefits of tax-free accounts, start contributing as early as possible and contribute consistently. Take advantage of catch-up contributions if you're eligible, and review your accounts annually to ensure you're on track. Diversifying across different types of tax-free accounts can also help you meet multiple financial goals, from retirement to education and healthcare. When using tax-free accounts, avoid common mistakes like exceeding contribution limits, making non-qualified withdrawals, or neglecting to update beneficiaries. Failing to follow the rules can result in taxes and penalties that reduce your savings. Stay informed about account requirements and consult a financial advisor if you're unsure about the best strategies for your situation. Strategic use of tax-free accounts can help you minimize taxes and maximize growth. For example, consider using a Roth IRA for long-term retirement savings, an HSA for healthcare costs, and a 529 plan for education expenses. By aligning your accounts with your goals, you can take full advantage of tax-free growth and withdrawals. Review your strategy regularly to adapt to changes in your life and tax laws. Tax-free accounts aren't just for adults. Parents can open custodial Roth IRAs for working children, 529 plans for education, and even HSAs if the child is covered by a high-deductible health plan. Starting early gives children a head start on building wealth and learning about financial responsibility. These accounts can also be powerful tools for teaching kids about the value of saving and investing. For retirement planning, tax-free accounts like Roth IRAs and HSAs can provide significant advantages. Roth IRAs offer tax-free withdrawals in retirement, while HSAs can be used for healthcare costs without taxes or penalties. By combining these accounts with other retirement savings vehicles, you can create a diversified, tax-efficient retirement income strategy. Education savings accounts like 529 plans and Coverdell ESAs are designed to help families save for future education costs. By taking advantage of tax-free growth and withdrawals, you can reduce the financial burden of tuition and other expenses. These accounts also offer flexibility in how and when the funds are used, making them a smart choice for education planning. Healthcare costs can be a major expense, especially in retirement. HSAs and FSAs provide tax-free ways to save and pay for medical expenses. By using these accounts strategically, you can reduce your taxable income and ensure you have funds available for healthcare needs. Remember, HSAs offer more flexibility and long-term growth potential compared to FSAs. High earners can benefit from tax-free accounts by reducing their overall tax burden and increasing after-tax returns. While income limits may restrict direct contributions to some accounts, strategies like the backdoor Roth IRA or investing in municipal bonds can help high-income individuals access tax-free growth. It's important to work with a financial advisor to optimize your strategy. Small business owners have unique opportunities to use tax-free accounts for both personal and business benefit. Options like the Roth IRA, HSA, and even certain 529 plans can be integrated into a business owner's financial plan. By leveraging these accounts, business owners can save for retirement, healthcare, and education while minimizing taxes. Tax-free investment accounts aren't limited to the United States. Many countries offer their own versions, such as the TFSA in Canada or the ISA in the UK. These accounts have different rules and benefits, but the core idea is the same. Allow your investments to grow without the drag of taxes. If you live or work abroad, research the options available in your country. Opening a tax-free investment account is usually straightforward. Start by researching providers, comparing fees, investment options, and customer service. Gather the necessary documents, such as identification and social security number, and complete the application process online or in person. Once your account is open, set up regular contributions to take full advantage of tax-free growth. With so many tax-free accounts available, choosing the right one depends on your goals, income, and timeline. Consider what you're saving for: retirement, education, healthcare, or another purpose, and match the account to your needs. Review the rules, contribution limits, and investment options before making a decision. Consulting a financial advisor can help you make the best choice. All investment accounts come with fees, and tax-free accounts are no exception. Look out for account maintenance fees, investment management fees, and transaction costs. These fees can eat into your returns over time, so it's important to compare providers and choose low-cost options whenever possible. Keeping costs low helps you maximize your tax-free growth. Regularly reviewing your tax-free accounts is essential to ensure you're on track to meet your goals. Check your contribution levels, investment performance, and beneficiary designations at least once a year. Adjust your strategy as needed based on changes in your life, tax laws, or financial goals. Staying proactive helps you make the most of your tax-free accounts. Tax-free accounts can play an important role in estate planning. By naming beneficiaries and understanding the inheritance rules, you can ensure your assets are passed on efficiently and with minimal tax impact. Some accounts, like Roth IRAs, offer unique benefits for heirs, including continued tax-free growth. Consult an estate planning professional to integrate tax-free accounts into your legacy strategy. Tax laws can change, affecting the rules and benefits of tax-free accounts. Stay informed about legislative updates and adjust your strategy as needed. Working with a tax professional can help you navigate changes and ensure you're making the most of your tax-free investment opportunities. Let's recap the best tax-free investment accounts. Roth IRAs for retirement, HSAs for healthcare, 529 plans and covered ESAs for education, municipal bonds for tax-free income, and FSAs for short-term healthcare needs. Each account has unique rules and benefits, so choose the ones that best fit your goals. By leveraging these accounts, you can grow your wealth more efficiently and keep more of your hard-earned money. Tax-free investment accounts are powerful tools for building wealth and achieving your financial goals. By understanding the options available and using them strategically, you can maximize your returns and minimize taxes. Take the time to review your current accounts, explore new opportunities, and create a plan that works for you. Your future self will thank you for making smart, tax-efficient choices today.